Whether you're starting a business or expanding your current one, you may need capital to pay for equipment, operations, or other expenses. A personal loan for business is one option for covering costs. Personal loans offer a lump sum amount that you can put toward business and personal expenses. You'll pay back the amount over several years at a fixed interest rate. Unlike some business loans, you usually don't need to back a personal loan with collateral. At the same time, it's worth comparing your options to determine the best way to finance your business. Understanding how personal loans work, along with how they compare to business loans, can help you make an informed decision. Can you use a personal loan for business? You can often use a personal loan for business, but some lenders set restrictions on how you can use the money. Many say you can't put the funds toward investing, gambling, or higher education, for instance. Some also forbid personal loans for business use. If the lender doesn't have this restriction, though, then you can use a personal loan for business. You could put the funds toward various expenses, including equipment and tool purchases, inventory costs, labor costs and payroll, maintenance, repairs, and renovations, rent and property. As long as your lender allows it, you can use the funds from a personal loan to launch your business, pay for space, purchase inventory, hire employees, and otherwise grow your business. How does a personal loan work? A personal loan is a type of installment loan, which means you repay it over a set period of time, often 2 to 7 years. In general, personal loans are unsecured and don't require collateral, an asset that the lender could repossess if you fail to pay the loan back. Personal loans typically have fixed interest rates, so your payments will stay the same month after month. They are most commonly used for personal expenses such as home renovations, healthcare bills, or debt consolidation. They're easy to apply for, requiring a few pieces of documentation and a credit check to determine if you have a fair or good personal credit score, though you may be able to apply with a cosigner or pursue a bad credit personal loan. Established credit history, with a diverse mix of accounts and a history of on-time monthly payments. A low debt-to-income ratio, DTI, which compares your total debt to your gross monthly income and helps lenders see if you can afford to take on more debt. Stable income. Because borrowers don't need to provide heaps of paperwork when applying for a personal loan, getting approved is quick. But if your business fails or you can't afford to pay back the loan, your personal credit takes a hit, not your business credit. This may make it difficult to qualify for other types of credit later, such as credit cards, auto loans, or even a mortgage. Pros and cons of using a personal loan for business purposes. Using a personal loan for business purposes may make sense for your business, but there are some considerations to keep in mind before you sign on the dotted line. Weigh the following pros and cons of using personal loans for business to decide if it's right for you. When it's a good idea to use a personal loan for business use. Business owners may want to consider a personal loan for business use in the following scenarios. 1. You don't qualify for business funding or SBA loans. Formal business funding options tend to have steeper requirements and more restrictions than personal loans. If you're just starting your business, you may not have enough revenue or time in business to be approved. Small Business Administration, SBA, loans, furthermore, may restrict how you can use the money. If you don't meet the loan requirements of a business or SBA loan, a personal loan may be easier to qualify for, even if you need to compromise on the amount of money you borrow. 2. You have good personal credit. When you take out a loan, the interest rate is largely based on your creditworthiness. If you have a good credit score of 670 or higher, you may qualify for competitive rates and low, or no, origination fees on a personal loan. Some business loans look at your business credit when evaluating your application for a loan. If you have good personal credit but insufficient business credit, you may get better rates and terms on a personal loan than you would on a business loan. 3. You don't want to put up collateral. Some business loans, such as equipment financing, require collateral to back the loan. Pledging collateral can help you get a lower interest rate, but you risk losing your asset if you fall behind on payments. You may also have to provide a personal guarantee on a business loan. This means that if your business can't repay the loan, you are personally responsible for doing so, which means your personal assets, such as your home, could be taken by the bank if your business defaults. One way to avoid pledging collateral or making a personal guarantee is by taking out a personal loan. There are still consequences for falling behind on payments, but you won't be risking any specific assets you pledged as collateral. 4. You don't need much capital. Taking out a business loan can give your business access to millions of dollars. But what if you don't need that much capital? Most personal loans start around $1,000 or $2,000 and go up to $50,000 or $100,000. Micro-businesses and home-based startups may only need a few $1,000s to start, so you may not need a business loan at all, at least not right away. In this case, a small personal loan may serve you well, giving you access to funds with few restrictions. 5. You need flexibility. When you take out a business loan, How you use the funds may be limited by the lender or the SBA. For example, if you only qualify for a microloan from an SBA intermediary, you can't use those funds to purchase real estate, such as a storefront. On the flip side, the best personal loans often have fewer restrictions than commercial funding options. This means you can use the funds to grow your business how you see fit, whether you need to pay off a business debt, purchase inventory, or cover your payroll. 6. You need funding fast. Getting approved for a business loan can take a while, anywhere from 30 to 90 days for an SBA loan. But applying and qualifying for a personal loan is a more straightforward process. Many lenders only require proof of income, address, and identity, like your driver's license and social security number. This means you may get approved and receive funding in about 1 to 5 days, if not on the same day. Other types of business funding. Before taking out a personal loan for business, compare all your financing options. Some alternatives include business loan, an installment loan that pays out a lump sum payment upon approval. Business line of credit, a flexible loan that pays out funds as needed, up to a defined limit. Equipment loan, a loan that helps you pay for equipment purchases, including machinery, vehicles, computers, and office furniture. Business mortgage, a loan to buy, renovate, or refinance a business or commercial property. Business credit card, a credit card for business expenses that may earn rewards points and other perks. Some cards have a 0% APR promotional period, though interest rates can shoot up after that period ends. Traditional business loans aren't always easy to qualify for. Many business lenders require you to meet certain requirements, such as minimum revenue, for example, $100,000 in annual gross sales. Minimum time in business, for example, 2 years or more. Ability to secure the loan with collateral, such as an asset, down payment, or security deposit. Business plan, financial statements, and other documentation. Small Business Administration loans. You can also apply for a business loan guaranteed U.S. Small Business Administration, SBA. These types of loans are offered by banks and credit unions and backed by the SBA, reducing lender risk and making it easier for you to get funding with competitive rates and flexible eligibility requirements. SBA-backed loans include 7A loans. A 7A loan is the SBA's primary business loan. 7A loans may be used for working capital, refinancing business debt, buying or improving business property, purchasing supplies and tools, and changes of ownership. To qualify for a 7A loan, you must be actively operating a U.S. for-profit business, meet the SBA's size requirements, be creditworthy and able to repay the loan, and be unable to get approved for a loan with reasonable terms from other sources. 7A loans are limited to a maximum of $5 million, though some 7A loan amounts are capped at $350,000. 504 loans. A 504 loan is a long-term, fixed-rate business loan to purchase or repair real estate, equipment, machinery, and other assets. 504 loans are offered through certified development companies, CDCs, and can't be used for working capital, debt consolidation, refinancing, or investments. To be eligible for a 504 loan, your company must be for profit, have a net worth of less than $20 million, and earn an average net income of less than $6.5 million for the 2 years before you apply for a loan. 504 loans are limited to a maximum of $5.5 million. Microloans. Microloans are small business loans provided by nonprofit community-based SBA intermediaries. These loans can be used for working capital, inventory, supplies, furniture, tools, and equipment, but may not be used to pay off debt or buy real estate. Microloans are limited to $50,000, with each intermediary setting its own eligibility requirements. In general, you'll need to provide some form of collateral and a personal guarantee to repay the loan, which must be repaid within 7 years. Is a personal loan the best fit for your business? Businesses need capital to survive and thrive, and a personal loan may provide the funding you seek. Personal loans are fast and flexible, and most don't require you to pledge collateral to borrow. If you need to borrow more than $100,000, however, a business loan may be a better option. A business line of credit or credit card is also worth considering, especially if you have variable expenses. Take time to compare all your financing options, including their costs and eligibility requirements. By doing this research, you can choose the funding path that best supports your business goals.